Welcome to The Explainer. Today, we're going to tackle something that affects pretty much all of us, the salary slip. We're going to crack that code and figure out exactly where your money goes. So, let's get right into it. Right? You see that big, shiny number on your offer letter, the cost to company or CTC, and then you look at what actually lands in your bank account, and you're like, wait a minute, where did the rest of it go? That gap is exactly what we're going to solve today. So, here's our game plan. First, we'll look at what salary even means to the tax man. Then we'll decode all those allowances and perks. We'll cover what gets taken out, talk a bit about retirement, and finally, wrap it all up into a financial toolkit you can actually use. Okay, so first things first, we have to get on the same page as the tax department. And believe me, when they say salary, they're thinking of something way, way broader than just your basic pay. And this is where it gets kind of wild. The legal definition of salary is, well, it's massive. Seriously, under the law, it pulls in almost every single thing you get from your employer. The best way to think about it is this. Assume everything is taxable salary unless you can find a specific rule that says it's not. Okay, so let's start building this up from the ground floor. The first major component of your salary is your allowances. You can think of these as straight-up cash payments that you get for specific reasons. Now, these allowances get sorted into three different buckets when it comes to taxes. You've got the fully taxable ones, no escaping tax there. Then you have some that are fully exempt, but honestly, those are pretty rare. For most of us, the real magic happens in that middle bucket, the partly exempt allowances. And in that middle category, there is one undisputed champion, the king of tax-saving allowances, the house rent allowance, or HRA. This is probably one of the biggest and most common tools you have in your arsenal to legally bring down your taxable income. So how do you figure out how much of your HRA is tax-free? It's actually a pretty straightforward formula. You just need to find three numbers. First, the actual HRA you get. Second, a percentage of your salary based on your city. And third, the rent you actually pay minus a small slice of your salary. Then you just pick the lowest of those three figures. That's it. It's a lowest number wins game. Okay, let's put some real numbers to this so it's not just theory. In a pretty standard example, say someone earns $45,000 a month and pays $18,000 in rent in a big city. The tax-free part of their HRA for the whole year works out to a whopping 1,62,000 rupees. I mean, think about that. That's a huge chunk of your income that the taxman can't touch. All right, so we've covered the cash part, but what about the other stuff your company gives you? Let's talk about the non-cash benefits. The official term is perquisites, but you and I, we just call them perks. So what's the real difference here? It's simple. An allowance, that's cash. It hits your bank account. A perquisite, or a perk, is a thing, a benefit, a facility. It could be a company car or a place to live. It's not money, but you better believe it has value. And that brings up a really important question, right? If your company gives you a free car or a house to live in, is it really free? Well, in the eyes of the tax department, the answer is a big no. These perks have a value, and that value gets added right back into your taxable income. So how does that work? Let's take company-provided housing. It's pretty logical. Depending on how big your city is, a certain percentage of your salary is considered the value of that house. So if you're in a huge metro, the taxman says, okay, that rent-free home is worth 10% of your salary, and adds that to your income for tax calculations. Okay, deep breath. We've added up your basic pay, your taxable allowances, and the value of all your perks. It's looking like a big number, right? Well, now comes the fun part. We get to start subtracting things. This is where deductions come into play. And the absolute easiest no-brainer deduction for every single salaried person out there is the standard deduction. It's just a flat 50,000 rupee deduction from your income. That's it. No proof needed, no questions asked. It's a simple, direct tax break for everyone. And this formula right here is the key to everything. It's the whole story of your payslip in one line. You start with your gross salary, subtract tax-free stuff like HRA, add back the value of your perks, and then you subtract your deductions. What's left at the end? That is your taxable salary. That's the number that actually matters. Okay, so we've been deep in the weeds of the monthly payslip. Let's zoom out for a second and look at the bigger picture, your long-term financial life. This means talking about retirement and a really big choice you have to make every year. So when you eventually retire, you're going to get a few different kinds of payments, and the tax rules treat them all differently. Your regular monthly pension, that's taxed just like your salary was. But those big one-time payouts like gratuity or cashing in your unused leave, they're mostly tax-free.
up to a certain point. And that limit can be huge. For gratuity, the tax-free limit is a massive 20 lakh rupees. That is a major, major tax benefit, designed to make sure that a huge piece of that loyalty bonus you've earned over the years is all yours to keep. And that brings us to the big choice you have to make. Stick with the old tax regime or switch to the new one. Look, the trade-off is actually pretty simple. The old regime has higher tax rates but lets you use exemptions like HRA. The new regime offers lower tax rates, but you have to give up most of those exemptions. The simple way to decide? If you have big deductions like HRA, the old regime is probably your friend. If not, the lower rates of the new regime might just save you more money.
Phew, okay. We have literally gone through your payslip from top to bottom. But I want you to remember, this isn't just a bunch of boring tax theory. This is your financial toolkit. So why does any of this really matter? Because understanding your payslip is about so much more than just numbers. It's about taking back control. It turns this confusing document into a clear, simple map of your money. Now you can see exactly where everything is going. And more importantly, you can start making smart choices to make your salary work way harder for you. And that brings us to the final question, the one I want to leave you with. Now that you know the rules of the game, now that you understand the real difference between a taxable allowance and a tax-efficient perk, what are you going to ask for in your next salary review? Just a bigger number or a smarter, more tax-efficient structure? The choice and the power is all yours.